We often talk to entrepreneurs and investors who want to legally reduce their income tax so they have more money to put back in the business, more money to put back into their portfolio. But for a lot of folks, capital gains taxes are as big or an even bigger issue, and those are the taxes they want to reduce. So today I'm going to talk to two different groups of people about three different strategies to reduce your capital gains taxes. One of the things that a lot of entrepreneurs overlook is if they're planning on selling their business one day, or heck, even if you're not planning on selling your business one day, sometimes just an offer comes out of the blue. What is that capital gains tax exposure going to be? So we've had people recently who the businesses make a couple $1 million a year, and so maybe they can save $1 million in taxes. Hey, that's pretty good. But in one case, the guy had a business that someone was interested in acquiring for about $60 million, and the tax bill was going to be about $14 million. And so you want to prepare for that kind of tax event well in advance before it's too late. Because what I've also seen is people who wait until they have a contract to sell their business, and then they're like, how do I reduce my taxes? And the answer is, you really can't do a lot. And so I'm going to talk to you about how you can do that. My name is Andrew Henderson, founder of Nomad Capitalist. We're a boutique consulting firm that helps 7- and 8-figure entrepreneurs and investors legally reduce your taxes, diversify and protect your assets, and find freedom in an unfree world with things like second passports, real estate overseas, gold buried deep in a vault below the earth, whatever it is that you want. And you can learn more at nomadcapitalist.com. So, two types of investors. One would be entrepreneurs, one would be investors. So an entrepreneur, you're selling a business, you're exiting, and you plan on getting a good price for your business. An investor could be stocks, could be cryptocurrency, it could be anything else. So those are kind of the three categories: business, crypto, and stocks, and let's put real estate in there too. But first, there are two types of people, and you need to figure out which camp you're in. And if you've been watching for a while, you know. There are Americans and there's everyone else. So if you're a U.S. citizen, green card holder, or otherwise a U.S. person for tax purposes, you are taxed no matter where you live anywhere in the world. And so capital gains are, generally speaking, more difficult to plan for than income. So if you have income from a business that is an active business, you can use the foreign earned income exclusion. You can use offshore company strategies to engage in deferral to reduce your tax rate substantially. That's all straightforward enough. When you have capital gains, there are a limited number, and this is not tax advice, but there are a limited number of entrepreneurs that we'll work with where what they think are capital gains are actually part of their normal business operations, and so they're able to run it into the active income strategy and reduce the taxes substantially that way. But if you've just got standard passive capital gains, your strategies as an American are either move to Puerto Rico and take advantage of their tax incentives, getting that down to as low as 0%. There are some caveats there, but generally speaking, you can get your capital gains down to 0. And you can also choose to expatriate, give up your citizenship, which means you would want another citizenship first. If you already have it, great. If not, can you get it by descent? Can you get it by investment? We've talked a lot about getting a second citizenship in other episodes. Or if you're a green card holder, you can relinquish your green card. If you're a long-term green card holder, that's going to be more painful than if you haven't had your green card for that long. And so everybody else, you're looking to basically do what the Americans are looking to do by expatriating. But you don't need to give up your citizenship. You're just going to give up your tax residence. So whether you're Romanian, German, Chilean, Australian, Canadian, whatever, you need to find a way to escape your tax system. So let's just assume that we're going to be talking about whether you're an American who needs to take a bit more of a bold step, either moving to Puerto Rico or cutting all of your ties for most people, or whether you're anybody else and you just need to move. You're going to be going through a procedure which depends on every individual person, depends on where you're living, to change your tax home. Okay, you want to change your tax home from where you are right now, which with high taxes, to a low tax place. And so Puerto Rico is not really a low tax place on its face, but if you can take advantage of the tax incentives there as an American, then it can be a low tax for you. And again, capital gains can be as low as 0. Everybody else, again, can you cut your ties with the country? And there's different criteria for everybody. What you want to keep in mind for capital gains is you need to plan in advance. So income is a little bit easier to plan for in the sense of as soon as you want to start saving money, you can make the move. And so if you set up a structure, let's just say in a UAE free zone, those are going to retain their 0% tax rate. And so you can set up your structure, you can set up your payment processors, you can set up everything you've got, move your employees overseas, whatever you got to do, set up your corporate structure. And the minute that you or whomever it is that's working in or owns the business decides to move, again, I'm generalizing, then you can start enjoying those tax savings. And so if you're making, again, $3 million a year, you might save $1 million to $1.5 million. And as long as you're staying overseas, as long as you're staying out of the high tax country that you're from, and as long as you are properly resident in a country that doesn't have tax or it's very low tax, then you're going to be fine. You're just going to enjoy that income for as long as you're there. There are some caveats on, when you can go back to your high tax country. You probably don't want to only do that for just a year, for example. You probably want to be gone for a longer period of time for most countries, but you can just flip that on and off like a light switch, subject to some caveats. When it comes to capital gains, what's often going to be the case is if your country has an exit tax. For example, if you are a US citizen or long-term green card holder and you leave, they're going to say, hey, what's the value of your assets? And so they may include a business valuation in there. Now, there's numerous different ways to value a business, and so you want to look at doing that. What a lot of people tell us is, oh yeah, my business is worth a fortune because I believe it's going to the moon. It's like, well, is that what it's really going to be valued on paper? If somebody values it on paper for a less optimistic number than you think it's worth, that's actually good for you when you're leaving your country, because that's what you may have to pay an exit tax on. Now, not every country has an exit tax, and there may be some situations where you're not subject to an exit tax. You can defer it, or whatever, it doesn't apply to you. Again, we're talking about all kinds of different countries in here, so it's hard to give you the advice. But if you've built up a really successful business with lots of employees, huge profit, assets, IP, whatever, you're going to have a harder time simply moving out of your country and not paying anything. And so what you're trying to figure out is, what's the spread between what the business is worth now and what you're going to sell it for in the future? Or what's your Bitcoin worth now and what you're going to sell it for in the future? Or what are your stocks worth now and what are you going to sell it for in the future? This is why I'm telling people, when you watch your Bitcoin go back down to fourth quarter 2020 levels, you have a great opportunity to basically go back 20 months in time and say, okay, now I'm going to leave my country. And if I believe my Bitcoin's going to go from 23,000 back to 69,000, I'm going to save myself all that capital gains tax, and it's tripling. And so if I bought in at 23,000 and it's worth 23,000, when I leave my country, I'm not going to pay an exit tax. Same thing if I bought a share of stock at $100 and I leave when it's $100, I'm not going to have an exit tax, because you see what countries want to do is they're going to say, hey, whatever you made while you were living here, we want a taste of that because we don't know when you're coming back. Certainly if you give up your US citizenship, you're not coming back in most cases, right? If you just leave your country, like Australia, some countries do allow you to leave security or to defer the tax in some way, but generally speaking, hey, you're leaving permanently, quote unquote. You can come back in the future, but you are telling them, hey, I'm leaving. And so they're like, well, great, so pay us what you owe us now, and then whatever you earn in the future, you can, that's free and clear. And so if you allow your business to be worth, $40 million, and that's what it gets valued at, and then like a month later, so you leave at 40 million, and then a month later, someone offers you 42 million. Potentially, again, not every country is an exit tax, but potentially your tax savings at the capital gains rate on 42 minus 40 million, 2 million. Okay, we've had people who've done that. Had a guy, we worked with all of our different tax lawyers a couple years ago. He came like on multiple different occasions. The time he finally pulled the trigger was he was ready to sell the business for $50 million, and there were a few little things we could do for him that some of our folks recommended. But the savings on a $50 million sale were going to be something like $600,000 or $700,000. Hey, you'll take $600,000 or $700,000. The ROI was still fantastic, right? But I think he first came when he had like a $12 million business, and so he should have been saving 38 million times whatever that tax rate was, like $9 million bucks. Instead, he went from saving $9 million to saving $600,000 or $700,000 because he didn't think ahead. If you're an American going to Puerto Rico, for example, and you're selling a business, it will be based on the time that you were spent in Puerto Rico versus the time that you were in the U.S. So if you're in Puerto Rico for 2 years, and then you sell your asset, business, crypto, stock, whatever, and you held that same asset, whatever it is, for 8 years, you're going to get a 20% discount, right? And so in that case, you want to stay in Puerto Rico longer. In pretty much any other case where you're leaving your tax home, which is you're expatriating from the United States, or you are simply moving out of your other high tax country, it's going to be based on the value when you leave. And so you want to, legally speaking, figure out, how do I value these assets and when's the right time to go? Again, when the chips are down is a good time to go if you are saving, if your goal is to save capital gains. So if you're a business, right, there's many different business valuation metrics, but the more employees you have, the more profits, the more assets, the more IP, that's going to be a challenge. And so in order to get potentially a better valuation, you want to be overseas to begin with, right? But don't call when your business is already, ready to be sold, or you just got a huge round, or you're in a business where you think like something in the cryptocurrency space. You could be getting a huge number now, whenever it's a bull market, But then, a year later, it could be a bear market and you're going to be in problem. I understand there's not necessarily a bull market right now, but I'm just saying if you're getting big valuations during a bull market in your industry and then it could go down later, you might be stuck leaving your country and paying a big tax. And then maybe you can unwind that in some countries, but maybe you can't. So don't leave when the business is worth 100 million or assets worth 100 million and then watch it go back down to 30. Either, liquidate when you leave, in which case you don't save any taxes anyway, or leave as early as you can, okay? And so move the business as soon as possible. I understand it's hard to predict, but you never know when you're going to sell a business or get an offer. If you do know, then you definitely want to be out as soon as possible. But figure out when you can leave before the business has a high valuation. Let's talk about stocks. If you're a stock investor, you're in a better position to have capital gains coming in from a tax perspective than dividends. Dividends are something that basically sits in the country and subject to the country's tax law. And so much like real estate, right? If you have real estate that's generating income, you are going to have to pay income tax on that in the country. Now, you may be able to depreciate it away or depreciate it down to a very low level, but real estate sits on the soil of the country where you're investing. And so if you buy real estate in the US, I don't care if you live in the UAE as an Australian citizen, you think, well, I'm not a US taxpayer. Well, but you are for that certain income, right? And so in the same way, a dividend is issued by a company that's traded in the US, that's going to be subject to US dividend tax. And so that could be, if you're living in a tax-free country, could be as much as 30%. And so not telling you anything that's tax advice, but might be worth considering living in a treaty country if you're earning substantial dividend income to reduce that 30% to a lower number. But it's going to be hard to get dividends from a country that taxes dividends and not pay any tax. If you want tax-free dividend income, you're going to have to go to a place and invest in markets where they don't tax dividends. Singapore, Hong Kong, places like that. But US and Canada and Europe, they are going to tax your dividends unless you live in a country where they have a tax agreement with. Capital gains are generally going to be easier. And so if you are an American who owns US stocks and you live overseas, you're probably going to be paying the full boat capital gains tax on those stocks when you sell them. But let's say you are an Australian who lives in the UAE and you own US stocks. You want to check that those stocks and their ownership of the stocks is properly structured to where you're not subject to US estate tax on everything above $60,000 when you die. A lot of folks invest in stuff in the US, whether it's real estate, stocks, what have you, and they're not aware that not properly structured, that can be subject to estate tax at a much lower level than an American taxpayer would have. But otherwise, from a capital gains tax perspective, you can generally earn capital gains on the sale of those stocks, and you can have that be tax-free. And so in most countries around the world, you can do that. They're not going to tax your capital gains, but they will potentially tax your dividends. And so if you're a growth investor, that's going to be an easier way to do it. You're going to want to simply live in a country where the place where you live doesn't tax it. And so the place where you have the asset, the investment, the stock market, for example, US stock market, Canadian stock market, what have you, as long as they're not taxing you on the capital gain, as long as the place where you're living isn't taxing you on the capital gain, then you can pretty much get away with paying zero tax. So it's a different strategy for a dividend investor versus a capital gains tax investor if the goal is to reduce tax as much as possible. Dividend investing, assuming that you're not going to change where you actually invest and put all your money in the Singaporean markets where there's no dividend tax to begin with. But if you're going to be investing in US, Canadian, European markets, earning dividends, you're going to want to live in a place potentially that has a treaty. Capital gains, you probably don't want to do that. Again, only if your goal is reducing tax as much as possible. Sometimes paying 5, 10, 15% is worth it for you, right? Just to have the lifestyle you want. But I'm talking about a tax reduction strategy. If you live in a country that has a tax treaty with, let's say, the US, then they may tax your capital gains 5, 10, 15%, whatever their number is. And so there are strategies where certain countries are, let's say, a non-dom country, and you can use the treaty, but you don't have to pay the tax on the capital gains. So there's many different strategies involved. But bottom line is capital gains are going to be easier than dividends. You can pretty much live wherever you want as long as you're not paying tax on foreign source income in that country. And so that's how you can do stocks. Things like cryptocurrency, Bitcoin, et cetera, are going to be easier because there's no fixed location. So kind of like the capital gains on stocks, you can enjoy these based on where you are living. So if you live in the UAE, if you live in Vanuatu, if you live in the Cayman Islands, if you live in a country that has territorial tax and your cryptocurrency is structured properly, sometimes it may want to be in some kind of foreign corporation. If you're living in a country that's tax friendly and you have cryptocurrency, as long as they don't have a special inclusion taxing that cryptocurrency a certain way, then you can generally enjoy zero tax on that as long as you've done the proper planning. And so because cryptocurrency is not necessarily registered somewhere, it's not like it's on the New York Stock Exchange or the Toronto Stock Exchange, it's in the cloud. There's no other country where naturally that would attract tax, and you're just going to be taxed on where you live. And so what you have to consider, whether you've got a business, whether you've got a portfolio, is my tax-friendly quadrant. There's you, and then there's your company. And there's where you're leaving, and there's where you're going. And so you've got basically 4 blocks of the tax-friendly quadrant. Where are you leaving and where are you going? If you are a U.S. taxpayer and you're going to leave New York and you're going to move to Puerto Rico, okay, great. You can get a tax incentive. You can get your income down to the single digits. You can get your capital gains down as low as 0. But you have to leave somewhere and you have to arrive somewhere, and you have to change your tax home. If you've got a business, the company also needs to leave. So in many cases, right, if you still have a company and you leave your company back in a high tax country, you may be subject under certain structures to a capital gains tax when you sell that business. And so, not always, but that will certainly make things more complicated, and you're probably not going to reduce your income tax. So you need to leave and you need to arrive somewhere else. Your business needs to leave and your business needs to arrive somewhere else. And again, depending on where you're living, even if you hold something like cryptocurrency, you may want to structure that in some cases. If you go to a tax-free country, you might just be fine owning, let's say, cryptocurrency or stocks in your own name. If you go to a country that taxes stuff that you earn in your own name, but it doesn't tax money earned in foreign countries, let's say at certain territorial tax jurisdictions, you might want to contribute that cryptocurrency to a company. You might want to put those stocks into a company. If you have stocks that you want to avoid estate tax on in countries like the US, the UK also has a similar provision, then those stocks may need to be owned in a foreign corporation in order for you to not only reduce the tax, but to reduce the estate tax. And then you need to figure out where the company is and where you're living and where the stocks are. So capital gains, bottom line, are easier to handle in many cases than income because countries let you buy and sell assets in their country, like things like on the stock exchange, and often you don't have to pay any capital gains tax. Things like cryptocurrency are cleaner. And again, there are more countries that just also don't tax capital gains. There are countries that may tax your income. Certain countries in the Caribbean that offer citizenship by investment. If you actually wanted to live there, some of those countries have an income tax, but not a capital gains tax. And so income from dividends, income from the business may be taxable, but those dividends, but the capital gains may not be. And so the core thing I want to tell you about reducing capital gains is do it earlier. Okay, you never know when your business is going to have a huge run-up. I've seen it myself. I've seen it with plenty of other people we've worked with where, business goes from $1 million a year to $10 million a year, and now people are circling, they want to buy the business, and you're still sitting in some high-tax country, and now you've got a very valuable asset. The time to get out is before everyone realizes what it's worth, and before it's really worth anything, right? If you can start the business overseas, all the better. If you can go overseas and then buy your stocks and then buy your Bitcoin and then buy whatever else it is that you want, even better. But don't wait until it's too late, because you can't just leave your country and not pay. You can't start a business from zero and get it up to be a $100 million company and say, you know what, I'm going to leave and not pay tax. They're going to say, great. I've literally seen people who can't renounce their U.S. citizenship, for example, because they just raised a bunch of money in the latest financing round, and now their business has a $600 million valuation, and they own a third of it, and they started with 0. And so for them to leave, they'd have to sell a whole bunch of their shares to pay the exit tax bill. If they just would have left, in one of the earlier financing rounds when it was worth $20 million, or if they would have started the business overseas to begin with, they would have been much better off. And again, the same thing goes when you buy a stock. If you're someone who buys growth stock and something shoots through the roof, you're buying one of these meme stocks that goes from $1 to $100 overnight, yeah, you're not going to have time to react to that. If you're buying a cryptocurrency and it's very volatile, get out, figure out what you have to pay, if anything. If you've got to pay an exit tax, consider that the price of your freedom, because you did make money in the country that you were living in, and they want their share for what happened while you were living there. But get out as soon as you can if the goal is to reduce tax, so that going forward, all those future gains can be taxed in a tax-friendly country under my tax-friendly quadrant.